When buying a house, a lot of people will choose a 30-year mortgage, but even though that is common, you might prefer paying off your house sooner, yet it's not always easy. In our case, I did the math earlier this year and realized that by doubling our mortgage payment, we could pay off our remaining balance in about 5.5 years, which is pretty cool. But the good news is that you don't have to pay thousands extra towards your loan every month in order to get rid of it sooner, because there are plenty of other ways to shave years off the term that don't involve doubling your payment. So today we're going to look at a few of these options and discuss when it might make sense to pay it off sooner. So the first option is to make bi-weekly payments, and this involves paying half of your mortgage payment every 2 weeks, which results in 26 half payments a year, which is the equivalent of 13 full payments or 1 extra mortgage payment a year. And it's estimated that this simple approach can possibly reduce your mortgage term by 6 to 7 years, and that's because bi-weekly payments can save you thousands of dollars in interest. Now, there is a catch. Keep in mind that some lenders, they do not allow partial payments, and if that is the case, making a bi-weekly payment will not work, because even if you pay half of the mortgage every 2 weeks, your lender might only process that payment once a month. So talk to your lender first to make sure they allow bi-weekly payments and that they will process your payment twice a month. And if so, another thing to be mindful of is that once you're set up on a bi-weekly schedule, you're usually required to continue making your payments every 2 weeks. A lot of lenders will not give you the option to go back and forth between a normal schedule and a bi-weekly schedule. Now, if your lender does not allow bi-weekly payments, another option is to make 1 extra principal-only payment on your own at least once a year, and the results are also similar to the bi-weekly payment because you end up making 13 full payments in that year. Now, if you pay your mortgage online, a lot of banks do give you the option to make an extra principal payment, and there's usually a separate line for you to enter this amount. You can also mail in a check. However, if you do mail it in, make sure you send your principal only payment on a separate check, and in the memo section of that check you have to write principal only. And this is important because some lenders do not automatically apply extra payments to your principal, so you have to specify where you want this money to go. And if you skip this step, there is a pretty good chance that they will also apply that payment to your interest. Another option is to pay a little extra each month, and there are different ways to approach this. For example, you can take your mortgage payment and you can round it up to the nearest $100, or you can take your mortgage payment, divide it by 12, and then make an additional principal payment in that amount every month. For example, let's say you have a $1,500 mortgage payment. You would pay the $1,500 as normal and then make an extra principal only payment of $125, and this can also result in 1 extra payment a year. If you can afford a much higher payment, another option is to choose a 15-year mortgage. Now, this will cut your typical mortgage term in half. However, if you purchase a new house later in life, and let's say you have plans to retire in the next 10 to 15 years, getting a 15-year mortgage can also prevent having to carry a mortgage into retirement. Now, the obvious benefit to this much shorter term is that you're able to pay down your balance quicker and build equity faster. However, it can also help you save a lot of money in interest. But of course, because you are splitting that loan term in half, that means you will also have a much higher payment. However, the good news is that getting a 15-year mortgage does not double your mortgage payment. So once you run the numbers, you might find that it's more doable than you think. For example, if you were to get a $250,000 fixed rate 30-year mortgage at a rate of 3.50%, you're looking at a monthly payment of about $1,100, excluding taxes and insurance. However, if you get the same loan at the same rate but choose a 15-year term, your mortgage payment will be about $1,700 a month, an increase of only $600. But one thing to keep in mind is that although paying extra can get rid of the mortgage years sooner, this might not be the best move depending on your circumstances. Now, if you're looking to retire early or achieve financial independence, getting rid of your largest debt after you paid off your other debts might make sense. Your house is probably your single most largest monthly expense. So obviously, if you're able to get rid of it, that means you're able to live on less money. But again, depending on your circumstances, it doesn't always make sense to pour extra money into paying down your mortgage, at least not yet. And to help determine whether this is the right move for you, you have to ask yourself some important questions. For example, do you have other debts such as credit card debt, student loans, or a car payment? If so, it might make more sense to allocate extra money to getting rid of these balances first. Do you have a fully funded emergency fund? If not, saving one should be a priority. Are you saving for retirement? And if so, do you need to increase your efforts? Again, another priority. But even if you don't have other debts and you're saving your money, before you start accelerating your mortgage payments, you might also consider investing first. Because here's the thing, if you were to take that same money and invest it instead, the return on that investment might be more than what you would save in interest. So it's definitely something to think about. Now, I am not a financial advisor, so before you start tackling your mortgage, I do recommend maybe talking with an advisor to make sure it makes sense for your circumstances. So that's all that I have for you guys today. I really hope that you enjoyed this video, and if you did, please give me a thumbs up, and if you haven't already, definitely consider subscribing. I talk a lot about personal finance, so if you like videos like this, I do post every weekend and sometimes during the week. Thank you again for watching, and I'll see you in a few days.